Hello, everybody. Brandon Griffin here, aka the Realty Resource, and I am going to re-record this quick-ish tip, which is about the liquidity crisis that we're facing right now in the mortgage industry and why you should care. Why I think this is important right now is because the mortgage industry is a $12 trillion industry that makes up about 70% of our economy, and honestly, it's the single greatest factor in determining the supply and demand in the housing market and thus home values. So this is something that I'm following, and I've never gone this deep. I've never tried to really understand the underpinnings until now. Normally things were predictable. Now they're not so much. Let's take a look at the way it normally works. All right, so this is the liquidity cycle. And basically what you have is you have a home buyer, right? And everyone's got a health bar that it's a financial health bar. It's like a video game. Home buyers typically will save up a down payment and pay that to a lender or a loan originator. And then that institution will front the rest of the loan, right, the actual value of the home, to the seller, and they will give you the house. And when they do that, they attach a note to it. That note is called a mortgage, and that is a promise to repay. Otherwise, the loan originator or the owner of that note actually gets the home. So they're called first lien holder. All right, then there's this thing called the secondary mortgage market, in which there are loan servicers, the people that you actually send your money to, your housing payment. And then there's this whole group of people called, whole group of people that are run by the FHFA, and it's Fannie, Freddie, and Ginnie. And those are government-backed agencies that purchase mortgages on the secondary mortgage market. So after the loan originator makes the loan, they sell the loan to a loan servicer. They sell it into the secondary mortgage market, where the loan servicer purchases the servicing rights and pays that capital back to the loan originator so they can make more loans. And then Fannie and Freddie get involved by actually purchasing that from them and then also forwarding that capital along. So basically, this allows them to continue to make loans even though they don't necessarily have the capital to do so. Now, in the secondary mortgage market, what they will do is they'll take these similar loans and they'll group them together by their terms, like interest rates. So a bunch of 30-year fixed at 4% will become one mortgage-backed security that then can actually be shares of that can be sold, right? And so those shares of the mortgage-backed security get actually sold all the way out to the investors, and these investors are hedge funds, 401ks, pension funds, insurance companies, and local and global banks. So this is how it normally works. And it works because in each step of this process, there's a financial instrument in orange here, which is your note, your mortgage, that then becomes a mortgage-backed security. And all of that passes down the line, and it's basically saying that there's a rate of return and a commitment here. And so those financial instruments are being sold across and divided up and then sold again. And that capital, the actual money that paid for your house, paid the seller the full amount, that's flowing down the line and refilling each person's coffer so they can continue to do whatever it is that they do again. Now let's take a look at like dividends or payments. So your actual housing payment is going to be paid to that loan servicer because they have the servicing right. They'll take a little bit of money away from the payment because that's their servicing fee. And then they'll pass the rest of it along to the Fannie, Freddie, Ginnie, the agencies, who will then pay the end line investors who essentially, are waiting for that return on investment that they were promised. And actually, that all circles back around to where you as a homeowner are getting a little bit of your own mortgage payment back if you have a 401k or a pension plan or something like that, because they're typically the ones investing in these mortgage-backed securities. Now let's look at the mortgage crisis, when things go wrong and what's happening right now. We've got COVID-19 coming in and essentially wiping out home buyers' ability to make these payments. Most Americans, unfortunately, don't have a whole lot of savings. So what do we do about that? Because this is the beginning, again, of the payments and the beginning of the whole process. Well, the government's going to step in, and they are going to say that there's all mortgage holders can now apply for a forbearance program, meaning they can stop making their payments. Please watch the video that I made about forbearance and why this isn't necessarily just as easy as it seems from the government. Yes, it's available, and no, it will not hurt your credit, but it will affect other things. And now we're going to see the underpinnings. There's a lot of dramatic effects in the actual cycle here that it's going to change. So if we stop that money from coming in after a few more loans, what you can see is that, let's see, hold on. Basically, we've got, there we go. The loan servicers are taking the hit because they are the direct link. They are still committed, you can see in red there, to pay Fannie and Freddie, Ginnie, the agencies. The agencies are still legally committed to paying the investors, so they have to keep making those payments. And then if that money's not coming in, then you can see that these loan servicers, many of which are not banks, right? So they don't have a whole lot of money to begin with, are running out of money very, very quickly. That's the liquidity crisis that we're running into. Now, the government can also figure out a way to help this, and so far what they've done is this. They've pumped money into Fannie, Freddie, and Ginnie, basically buying up as many of these mortgage-backed securities as is necessary to refill their coffers. And you can see the effect would be that essentially they're going to get more money, but the loan servicers who are not getting this are going to wind up out of business. So you can see that interaction there. There are several of them that are at risk of just disappearing. And so this is the crisis that we're facing right now. And what happens is, and actually now that I'm recording this and it's today instead of yesterday, we actually do have some information. The government is doing what they can, but it's probably not going to be enough. They will purchase some of these loans from the loan servicers, but they're much more expensive. And all of that risk and all that cost is going to be passed along all the way down to the loan originators and thus to the home buyers. So jumping into why you should care about this, why do you care about mortgage servicers? It's going to get harder to borrow. There are going to be higher interest rates. That cost will be passed along. There are going to be stricter qualifications. Last week in my Rooster video, I told you that Chase went to 700 minimum FICO score and a 20% minimum down payment for their conventional loan product, which cuts out more than half of the buyer pool. There's just going to be less options too, because the servicers that don't have the ability to hold these loans on their books are going to either go out of business or stop making loans. So that's why I said this week we really need to shop around. Things are different now. Not everybody has access to the same stuff. Housing values are going to be affected by this because a significant amount of demand being removed right when people were already losing income will shift supply and demand. And so if you want to know more about that, I recorded a video about what I think housing prices are going to do. And while we don't have a crystal ball, this is one of the key components in what determines housing prices. So if housing prices drop, I mean, there's opportunity there, but not if people can't get loans to purchase property. So most buyers not being able to take advantage of that, that's a double whammy. And finally, this is a big issue. This uncertainty and the departure from the way that things normally happen in the mortgage market, that is what causes the rate volatility. So without really being able to predict much, that risk is going to be priced in, and it's going to be much harder for us as home buyers and home sellers to deal with it. The exit of the forbearance programs. So when you stop making your payments, what happens? So far, they're not forgiving those payments. They're going to be due. And that is going to get really interesting, really, really quick. And I will continue to follow that. But every servicer is different. So I've done a few videos about forbearance as well, which you should check out. Call your servicer and ask. It will affect your refi options down the line and your subsequent purchase options. So that's it for today. That's just a little look at what this liquidity crisis is. We're going to keep following it. Really, the takeaway here is, call your trusted professional, because there's not a whole lot you can actually do to change this, but there's a lot you can do to change your preparation for whatever your goals were. And that is talking to a professional who understands how those are affected and what your best plan of action is. So we'll be talking to one of those professionals today at the Live at Lunch. And so you should check that out. It's Lindsay Tatum. All right, guys. Thank you so much. Have a good one.
Thank you so much for watching this video. This has been Brandon Griffin, aka The Realty Resource. If you can help us out by liking, subscribing, following, and if you want our weekly updates for anything real estate related, go ahead and hit that notification bell. Also, if you have any questions, please put them in the comments below and we'll go ahead and answer them for you. Have a good one.